For this session, we will talk about leases, which is covered under PFRS 16. So PFRS 16 is considered a new standard. Before, what governs its standard for leases is PAS 17. However, this was already superseded by PFRS 16. Before in your PAS 17, we have your lessee and your lessor accounting, and you need to classify both. Either it is an operating lease or a finance lease. However, under PFRS 16, your lessee can only account for it as a finance lease, while your lessor can account for it as operating lease or a finance lease. So what prompted the change on the accounting for the lessee? Now we said as a definition of asset, so long as you have a control over the economic benefits of that particular asset, you own that asset or you should recognize it as an asset per accounting. So again, as long as you control it, you should recognize it as an asset. So before in past 17, if you will lease an asset, meaning you will rent an asset, in short, you have the control over the asset during the lease term. The lease term is known as the lease period or the period of rent. So as you can see, lessee, if ever under past 17, you need to recognize either operating lease or a finance lease. When we say operating lease, the amount of your rent will purely be recognized as an expense. In a finance lease, you need to recognize an asset. That particular problem is solved under PFRS 16. Why? Because now we say that the asset is controlled during a lease. Therefore, a lessee should not recognize an expense purely, but should recognize an asset. That's why in your lessee, we remove now an operating lease classification, but purely finance lease because of the definition of an asset. Because lessee will always control the asset during the lease term. That's why no more operating lease criterion. But later, you will see that there is a particular exception applicable to your lessee in which we can recognize an operating lease. As I said, leases is considered as a mixed account. Why is it mixed account? Because unlike your other standards, let's say we have your PAS 16, we are talking only on an asset section, property, plant, and equipment. PAS 2, we are talking about inventory that is only under your asset. PAS 41, we talk about your agriculture, which is only an asset. However, PFRS 16 is a mixed account before because we will discuss here two items, asset and a liability. For the asset, we call it as lease receivable. For the liability, we call them lease liability. Lease receivable happens in case of a lessor, while lease liability arises in case you are a lessee. So in leases, we talk about two accounts, asset, lease receivable, and liability, lease liability. So just like any other topic that we have discussed, we will know the recognition of this particular liability and asset. Next, the measurement of this liability and asset. And of course, in case we discuss also your disclosure, but generally we will only discuss recognition and measurement. Now, by now, you know that there are two persons that is present in a contract of lease. These are your lessor and your lessee. So if one recognizes receivable, the other should recognize as liability. That is known as your reciprocal recognition of those accounts. If one has an asset, one has a liability or an equity pursuant to your accounting equation. So now let's dwell on PFRS 16 leases. So first, what is a lease? A lease is a contract which conveys the right to control the use of an identified asset for a period of time in exchange of a consideration. So the lessor will exchange an asset which the lessee will use for a certain period. This period of time is known as your lease term, and the lessee will pay for a consideration. This consideration is known as your lease payment, right? So the lessor actually is the one who owns the property, but the lessee is the person who rents the property. So the lessor now want to rent out the property to lessee. So the lessee will rent that property. So lessor owns, lessee rents. So in your contract, pursuant to PFRS 15, we need to separate whether there is a lease component or a lease or a non-lease component. So when we say lease component, of course, this is the contract between the lessor and the lessee pursuant to the usage or the lease of a particular property. But non-lease, of course, this is not part of the lease contract or not rent itself. So for example, in your contract, it is provided that you have here a lease of a property for 5 years and then also included the housekeeping for 5 years. So there are two items inside the contract, the lease for 5 years and housekeeping for 5 years. Pursuant to IFRS 15 or PFRS 15 revenue from contract with customers and PFRS 16, it provides that you must separate the contract components from lease and non-lease. So the lease component here, of course, is the lease for 5 years. The land lease is the housekeeping. So what we do if there is one bundled price, normally in the contract, we only have one bundled price. So this price should be allocated to each component based on their standalone price at contract inception. So for example, your total contract price is 3 million. It includes 5-year lease and 5-year housekeeping. So what we do, we need to separate the 3 million for your lease and for your non-lease using their standalone price. So let's say the standalone price is 2 million for lease and 500,000 for non-lease. Okay, how will you allocate that again? You allocate it to using your relative fair value method. So if you still remember the allocation using a relative fair value. So in case there is a contract and it is a bundled contract, you need to separate it for the lease and non-lease component. Now we go to your first accounting, lessee accounting. We said for lessee, what we have here is your lease liability. So we are accounting for a lease liability for your lessee accounting. But general rule is that for lessee accounting, we recognize right of use of asset and your lease liability. Right of use of asset now is the asset which you control. So for example, the lessor will lease a building to the lessee. So the lessee will not recognize the building, but the lessee will recognize it as right of use of asset. Okay? So the line item is known as right of use of asset but not building. So the lessor will either remain it as building in case that is in operating needs or will remove it in case it is e finances. Later, we will go to your lessor. But what is important here is that you know you will not recognize itself as a building, but you will recognize the property as right of use of asset. And then we have your lease liability. So in your lessee accounting, at the time of the lease or the inception of the lease, what we do is we debit right of use of asset and we credit lease liability. Now, the question is, what are the items of your right of use of asset and what are the items of your lease liability? So what compose your right of use of asset and what composes your lease liability? Later, we will discuss what are those items inside your right of use of asset and lease liability. Now, as an exception to that rule, as we said, your lessee accounting should normally account for it as a finance list. But the exception now is that you can recognize operating lease if the lease asset is first, it is a low value asset such that it is of a small amount and it is immaterial. For example, you are leasing a table, you are leasing a chair. So those amounts are low value asset. So in case you will recognize it as an expense. Or the lease term is too short, you will recognize it as an expense. Again, in our introduction a while back, we said that under PAS 17 before, for your lessee, we recognize either operating lease and finance lease. But now under PFRS 16, we are only accounting for finance lease. So the general rule, therefore, as a finance lease, we recognize a right of use of asset for the asset that we have control, and then lease liability for the amount of our liability over the rent. However, as an exception to that rule, you can recognize an expense or an operating lease instead if the lease asset is a low value asset or the lease is a short term lease. So when we say short term lease, it depends on your judgment on what is short term and what is long term. Perhaps 5 years can be considered as long term. 1 year, 2 years can be considered as short term. It depends on your judgment. But generally, when we say short-term lease, this must be at least 1 year or less than 1 year because it is too short based on our definition of PAS 1 on what is short or what is current. Okay? So let's say accounting general rule, finance lease, that is the recognition of a right of use of asset and lease liability. Exception to the rule, we use your operating lease, that is your low value asset and short-term lease, wherein we recognize rent expense over the period of the lease. Now, for your measurement for Lessee accounting, we said we have two items that we need to recognize. We have your right of use of asset and we have your lease liability. So, how do we recognize or how do we measure your right of use of asset and how do we measure your lease liability? Because, of course, you will recognize lease once you enter into a contract of lease. And once you enter into a contract of lease, then you are a party to the lease. Once you are a party to the lease, you recognize lease liability or lease receivable, whether you are the lessee or the lessor, depending on what is your position on the list. So now we go with your measurement. So initially, we need to measure your lease as a right of use of asset, recognition, and then your lease liability. Now the question is, what composes your right of use of asset and what composes your lease liability? First, the composition of your right of use of asset. So your right of use of asset is composed of your lease liability, which we will discuss later, initial direct costs incurred by the lessee, less estimated dismantling costs, less incentives before commencement of the lease. So that's how we will compute for the right of use of asset. As you can see, it is almost like a property, plant, and equipment wherein we have your cost plus your transaction cost. And your transaction cost is your direct cost and your dismantling cost. I know that you have already memorized or familiarized yourself with a dismantling cost. That is the present value of your future cost to remove that particular property lease. So for example, you are leasing a machinery and you place that machinery in your building. So if in case you will need to dismantle that machinery in the future, you will add the cost of removing that particular machinery as estimated dismantling cost. Sir, why do we need to add the transaction cost and your initial dismantling cost into the right of use of asset? Because normally that asset is a property, plant, and equipment, but we do not recognize it as property, plant, and equipment under PAS 16, but we recognize it as property under PFRS 16 known as right of use of asset. Please do not forget that. But since they are in the nature of a particular property which should have been under PPE, we use the measurement principles under your PPE. That's why we add initial direct costs and dismantling costs. Also, you need to deduct any lease incentives. So if there are lease incentives, you need to remove that to compute for the right of use of asset. Now we go to the measurement of your lease liability. How do we measure your lease liability as to your lessee? Lease liability is equal to your present value of your lease payments. The question is, what are these lease payments? Your lease payments are the following. First, that is your fixed lease payments. So for example, if you have e-rent and the rent is 50,000 per month, the 50,000 pesos per month is considered as your fixed rent payment. Next, you have your variable lease payments. These variable lease payments normally are lease payments based on your conditions, such as, for example, you will pay 50,000 per month as a fix. However, there will be additional 5,000 per month in case your income increased by 10% as compared to the previous period. So the condition there is if there is an increase of 10%, you will give additional 5,000. The additional 5,000 is variable list payments. So normally variable list payments are conditional based on the contract of lease. Next, you have your guaranteed residual value by the lessee. So what is this guaranteed residual value by the lessee? The guaranteed residual value by the lessee means the amount of residual value or the amount of the asset after the lease term. So for example, we have an asset such as your machinery. Take note, this machinery will be used by the lessee. Now, if the lessee will make use of that machinery, our problem may be what is the value of that machinery after the lease term? So normally, that value is known as a guaranteed residual value by the lessee. So the lessee now guarantees that at the end of the lease term, this is still the value of your property, meaning it will not go down by that particular amount. So that can be guaranteed or unguaranteed. When we say it is guaranteed, if there is a, for example, it is guaranteed by the lessee at 300,000, but the fair value only at the end is 250,000. Since it is guaranteed at 300,000, the lessee is liable for additional 50,000. But if that is unguaranteed, whatever is the value at the end, there is no liability as to the change or difference of that value based on what is provided as the residual value. So in our example, if it's guaranteed 300 versus 250, liability of the lessee is additional 50. But if in case it is unguaranteed, the liability of the lessee will only be based on what is the value, that is 250, no more additional 50,000 because the whole value of 300 is not guaranteed by the lessee. Next, we have your purchase option. That is your right to purchase the property at the end of the lease term. However, you don't have the obligation, meaning you have only the option but not the obligation. Since this is only an option, any price on that option should be included. Next, any penalties for terminating the lease should also be included as part of your lease liability. Okay, so we have here your lessee. What will your lessee recognize? E-lease liability. But actually, you recognize two items, right of use of asset and lease liability. Your right of use of asset, what are the items for its measurement? These items. For your lease liability, we have the following items. Please do not forget those items inside the right of use of asset and lease liability. Next, subsequent measurement. So how do we subsequently measure your lease liability? We're done on your initial recognition. We're done with your measurement initially. We go now with your subsequent measurement. Your lease liability should be measured using effective interest method. On what is effective interest method, you will learn that when you go to your higher accounting. Generally, this effective interest method, what we do is we compare the total fees amount versus the present value. Because normally, you know that your lease liability should be measured at present value. So for example, our fees amount is 500, our present value is only 450. So there is 50,000 pesos. This 50,000 pesos is amortized over the lease term through effective interest method so that by the end of the lease term, the fees amount will equal or the total amount will now be zero because the list term now is already used. Okay? So in your effective interest method, and that is for higher accounting on how you will compute that, you will learn that in your AE 105 or intermediate accounting 1. We go now with your right of use of assets. So how do we subsequently measure it? Your right of use of asset, we said, is considered as EPPE. And under your PPE, we have two models, right? Cost model or revaluation model. However, under IFRS 16, what is provided only is your cost model. So under cost model, you know that you should compute it based on the book value or the value initially less the accumulated depreciation less the accumulated impairment loss. So how will you depreciate then your right of use of asset under your PFRS 16? Your right of use of asset is depreciated using the lower of your useful life of the lease asset or the lease term. So for example, the useful life of the lease asset is 8 years and the lease term is only 5 years. You should depreciate it over 5 years. But you will use the lease term if ownership will transfer to the lessee at the end of the lease contract. Okay? So you depreciate it over the useful life of the lease asset or the lease term, and you will use they should be useful life. You will use the useful life if ownership will transfer to the lessee at the end of the lease contract. So, for example, it is provided in your lease contract that at the end of 5 years, the property is now owned by the lessee. That is normally known as your rent to own. So if that is considered a transfer of ownership at the end of the lease term, you will use the useful life instead. So even if the lease term is only 5 years, but the useful life is 8 years, since you will own that property at the end, you use 8 years. Okay? So initial measurement, right of use of asset, we have four items. First, we have your lease liability. Now, after your lease liability, you have your direct costs. After your direct costs, we have your dismantling costs, and we deduct any lease incentives. But for your lease liability, we measure at your present value of your lease payments, which is composed of your fixed lease payments, your variable lease payments, your purchase bargain option, your guaranteed residual value, and any penalties in case of default on the lease. And then on your subsequent measurement, your lease liability should be measured using effective interest method, and the right of use of assets should be measured based on your cost model, and the useful life is depending whether there is a transfer of ownership or none. If there is a transfer of ownership, we use the lease term, we use the useful life. If there is no transfer of ownership, that is the lower of useful life and the lease term. We're done with your lessee accounting. Remember the recognition, right of use of asset, and your lease liability. Remember the initial and subsequent measurement. For your lessor, we have two types of lease. You have your operating lease and your finance lease. So as we said, for your lessee, we do not classify it already. It is purely finance lease wherein we recognize right of use of asset and we recognize lease liability. But for your lessor, we will only recognize both operating and finance lease. Okay? So that is new under PFRS 16. So operating lease is, of course, a lease that is not considered a finance lease. Therefore, what is a finance lease? A finance lease is classified as such if there is a transfer substantially of all the risks and rewards incidental to ownership of an underlying asset. So if there is a transfer of ownership from the lessor to the lessee, we call it a finance lease. And your finance lease can either be a direct financing lease or a sales type lease. Your finance lease can either be a direct financing lease or sales type lease. So these are your two types of finance lease under lessor accounting. So when is there a finance lease? What we know only if there is a transfer of ownership. Okay. So when we say there is a transfer of ownership, if there is any of the following, so individually or in combination, first, of course, a transfer of ownership. Next, if there is an option to purchase, if it is major part of the economic life of the asset, or there is a substantial minimum lease payments, or it is of a specialized nature. It is major part of the economic life if ever the life is 75%. So this term over the useful life. And substantial minimum lease payments if we compute the present value of your lease payments all over the fair value of your property. And this is greater than or equal to 90%. Okay? So these are the different tests if there is a finance lease. General rule, there is a finance lease if there is a transfer of ownership. As an exception to that rule, you can say there is a finance lease if the following items are present. Any of them. First, transfer of ownership. Next, option to purchase. Next, major part of economic life. Substantial minimum lease payments. Minimum lease payments. And then, if ever the lease asset is of a specialized nature, we can consider them finance lease. After we know what particular type of lease, then in your finance lease, we are now ready to account on a direct financing lease or a sales type lease. We start first with a direct financing lease. So since you are the lessor now, you are to recognize a lease receivable. So the lease receivable is equal to your gross investment in the lease. When we say gross investment in the lease, this is equal to the amount of your total receivable. So at face. Next, we have your lease asset, which should be derecognized. Why is your lease asset derecognized? Because we said your finance lease, there will be a transfer of ownership. Since there is a transfer of ownership, you do not own this asset already. So tatanggalin mo na yung lease asset na pinaparenta mo. Next, the direct cost is added to the cost of the equipment or the property in case there are direct costs on the lease. Lease income, you will not recognize a lease income, but you will recognize an interest income based on effective interest method. So you debit a lease receivable, you remove your lease asset. So that's how you will recognize it. And then once you collect something out of your lease receivable, so debit cash, credit lease receivable, and then you can recognize interest income out of your lease receivable. So debit lease receivable, credit interest income. Take note, since this is considered a finance lease, there is no lease income. Take note of that. In a finance lease, there is no lease income. Again, you will recognize a lease receivable based on the gross investment in the lease. Generally, that is the face amount of the lease. And then we have your lease asset, which is now derecognized because there will be a transfer of ownership in your finance lease. If there is a transfer of ownership, take note there is no more ownership to talk about. Therefore, that is not your asset. Direct cost, any cost on your finance list should be added to the cost of the property. And if in case, what income can be recognized? Only interest income, no lease income. So here, when you collect the lease receivable, you debit cash, you credit lease receivable. Once there is an interest income, you debit lease receivable, you credit interest income. That is based on your effective interest method. Take note, no lease income, but there is interest income. Sorry, no lease income, but there is interest income. Next, lessor accounting for a finance list, sales type list. We're done with a direct financing list. So in a direct financing list, remember, you don't have a lease income, but there is an interest income. Now, in your sales type lease, you lease your asset, but the leasing of your asset is your main operation. Therefore, we treat the lease as if a sale. So here, we have your revenue, your cost of sale, your profit, and your initial direct cost. Your revenue is equal to the fair value of the underlying asset, or if lower, the present value of your lease payments. You already know what is your present value of lease payments, diba? So this is the lease liability a while back. Now that is your lease receivable. That is your present value of lease payments. It's still the same items of your lease payments. We still have your fixed, we have your variable lease payments, your guaranteed residual value, your bargain purchase option, and any penalties arising on the lease. Next, we have the cost of sale. What is the cost of sale? Your cost or the carrying amount of the lease asset. A while back in your direct financing lease, this is not considered a cost of sale, but only a the recognition of the lease asset. And here, since we treat your lease as a sales type, as your main operation, we can recognize a profit. That is your revenue less cost of sale. And then we have also your initial direct costs, which will be considered as an expense. Remember, in your direct financing lease, it is an addition to the cost of the lease asset, while in your sales type lease, your initial direct cost is considered as an expense. So please take note of those differences in between direct financing lease and sales type lease. In direct financing lease, we recognize a lease receivable. In your sales type lease, generally we recognize these items, revenue, cost of sales, and profit. And of course, lease receivable based on your gross investment on the lease. Main difference, we have a profit here. In your sales type lease, there's no profit in your direct financing lease. And your cost of sale is considered the recognition under your sales type lease, but that is purely a recognition of the cost of the asset based on a direct financing lease. Now, in your finance list, sales type lease, there is a difference in case there is a guaranteed or unguaranteed residual value. So what is the effect of that guaranteed or unguaranteed residual value as to your lease receivable, sales, and cost of sales? In a guaranteed or unguaranteed residual value, they are still placed on your lease receivable. Take note, this lease receivable, as we have discussed again, this is based on your gross amount or the total face value of the lease. Next, you're guaranteed whether it is included in sales or cost of sales. So the residual value is placed in your sales in case it is guaranteed, while the residual value is placed in your cost of sales if it is unguaranteed. Take note, if it is guaranteed, you add it as part of your sales. If it is unguaranteed, you deduct it as part of your cost of sales. So cost of sales less unguaranteed, sales plus guaranteed. Okay? So total sales plus guaranteed in case it is guaranteed, cost of sales less unguaranteed in case it is unguaranteed. And then the difference now is your gross profit. Just need to know that the effect. If it's guaranteed, you add it on the sales. If it's unguaranteed, you deduct it on your cost of sales. Again, sales type list, what is the effect of a residual value? The effect of a residual value differs if ever it is guaranteed or unguaranteed. If the residual value is guaranteed, you need to add it on the sales. While if it's unguaranteed, you need to deduct it on your cost of sales. So we're done with your finance list on your lessor. Again, on your lessor, we recognize finance lease and operating lease. Finance lease that can either be a direct financing lease or a sales type lease. In the sales type lease, you recognize gross profit. In direct financing lease, you do not recognize gross profit. There is an interest income on both. There is lease receivable on both. However, there is a sale here and cost of sales. Here, purely a derecognition of the lease asset. So since we're done with your finance list for your lessor, we go now to your operating list. So for your operating list, you will recognize e-revenue. And what is that revenue? We call that your rent revenue. A while back, in your direct financing lease, we do not have a rent revenue, but we have an interest income. But in your operating lease, we have now a rent revenue. So the lease payment is considered as income over the lease term. So we have your rent revenue or lease revenue, or rent income or lease income, whatever term you use, so long as they denote the same income from rent. And then a while back, your costs before, we have only your initial direct costs. But here we have your depreciation. Why? Why do we have depreciation in your operating lease? Because in your finance lease, it is derecognized, right? In your finance lease, it is derecognized, whether it is sales type or direct financing lease. Therefore, there is no depreciation. But here, since there is no derecognition, take note in operating lease, there is no derecognition, then we can recognize depreciation. Okay? Finance lease, there is derecognition, no depreciation, but we have direct costs. But in your operating lease, there is no derecognition, therefore there is depreciation. Next, initial direct costs. They are added as part of your operating lease to the carrying amount of the asset. So this is the same with your direct financing lease. We add it to the cost of your property, 'di ba? So initial direct costs, direct financing lease, what did we do? We add it to your cost of property. Sales type lease, it is considered an expense. While in your operating lease, again, it is part of your cost of property. Depreciation, in your direct financing lease, there's no depreciation. Sales type lease, there's no depreciation. Operating lease, there is depreciation. Next, the recognition of the asset. In direct financing lease, there is the recognition. Sales type lease, there is a the recognition of the asset. Operating lease, there is no the recognition. Lease revenue. There is no lease revenue on sales type lease and direct financing lease, but there is on your operating lease. Also, interest income. There is both on sales type lease and direct financing lease, but nothing on your operating lease. Okay? So please do not forget the differences on those accounting. We go back and summarize what we have learned in your IFRS 16. IFRS 16 prescribes for mixed account. We have to account for the lessee and for the lessor. For the lessee, we have your lease liability. For the lessor, we have your lease receivable. So since we have here a lease liability, for your lessee, we learned that we account for two items, right of use of asset and lease liability. For your lessor, we still need to look whether that is finance lease or that is operating lease. There is a lease receivable in a finance lease, whether that is a sales type lease or a direct financing lease. In an operating lease, generally, we do not have a lease receivable because whatever is the payment, that is the amount of our revenue. And take note of the differences of the three: direct financing lease, sales type lease, and operating lease in case of accounting for the lessor. That's it for IFRS 16. We need to recognize again the accounting of your lessee and your lessor, and how do we measure those recognized items initially and subsequently.